There's a specific 3-year window in retirement that determines more than any other period whether your money lasts or doesn't. Not the year the market crashes, not the year you have a major health event, not the sequence of returns over the full 30 years. The first 3 years. A study out of Texas Tech University found that a market decline of just 15% in the first 2 years of retirement can permanently reduce sustainable income by up to 30%, even if the market fully recovers afterward. Fully recovers, still down 30% permanently. Most people heading into retirement have never heard that number, and most of them are walking straight into that window right now. What I want to do today is show you exactly why that first 3-year window is so dangerous. Not with theory, but with the actual mechanics. The math behind what happens to a portfolio when withdrawals and volatility collide. I'm also going to give you the 5 specific things that go wrong in that window, most of which have nothing to do with the market. And at the end, I'll walk you through the buffer strategy I use with clients to make that window survivable. Not just financially, behaviorally. Because the behavioral piece is where most retirement plans actually break. I'm a David. I've spent 25 years doing retirement planning. I've watched people walk into retirement with strong numbers and walk out 3 years later in a hole they couldn't dig out of. Not because they were careless, because nobody told them what they were actually walking into. 5 things. Let's go through each one. Before we start, drop a comment below. Are you within 5 years of retirement or already in it? I want to know who's in the room. Let's dive in. Number 1, sequence of returns. Risk is real and it's asymmetric. This is where I want to start because everything else builds on it. Most people understand that markets go up and down. What most people don't understand is that the order of those ups and downs, the sequence, matters enormously once you start withdrawing money. And it matters in a way that is fundamentally asymmetric. Here's what I mean. If you're still working and contributing to a 401k, a down market is actually good for you. You're buying shares at lower prices. A recovery lifts your whole portfolio. The sequence doesn't matter. The moment you retire and flip from contributing to withdrawing, that math inverts completely. Let me show you what the data actually shows. Take 2 people. Both retire at 65 with $1 million. Both average a 7% annual return over 20 years. Both withdraw $50,000 a year. The only difference, person A gets good returns in the early years, bad returns later. Person B gets bad returns early, good returns later. Same average return, same withdrawal amount, same 20-year window. Person A ends with over $1.1 million at 85. Person B runs out of money at age 80. 5 years of living with nothing left from the same starting point, same withdrawal rate, same average return. The only variable was the sequence. I had a client, retired engineer, late 60s, who came to me in 2023. He'd retired in January 2022. 6 months in, the market was down 23%. He hadn't built any kind of buffer. He was pulling $6,800 a month from his IRA to cover expenses. Every dollar he pulled out was a dollar that wasn't there when the recovery came. He said to me, "I knew markets could drop. I just didn't know it would feel like this when I actually needed the money." That's the asymmetry. It's not about the percentage. It's about the direction of cash flow at the moment of the drop. Practical takeaway. The safe withdrawal rate you calculated during accumulation is not valid in a bad sequence. Before you retire, stress test your plan against a 20 to 25% market decline in year 1. Not to predict it, to know what you'd do if it happened. But sequence of returns is only part of the danger. Here's what most people miss, and this one is almost entirely behavioral. Tell me in the comments, have you stress tested your retirement plan against a market drop in year 1? Yes or no? I'm genuinely curious. Number 2, retirement spending spikes before it settles. This one surprised even me when I first started tracking it across clients. There is a well-documented pattern in retirement spending called the retirement spending smile. Researchers at Morningstar and others have studied it for years. The basic shape, spending is high in the early years, drops in the middle years, then rises again in the final years driven by healthcare. The curve looks like a smile. What most people focus on is the declining middle. They say, "Great, my spending will drop over time. My plan is conservative." Here's where it gets interesting. The early peak is bigger than most people plan for. Vanguard research found that newly retired households consistently underestimate first-year spending by an average of 23%. Not 5%, not 10%, 23%. You know why? Because retirement is an event. You've been waiting for it. You traveled more than you expected. You finally fixed the kitchen. You bought the thing you'd been deferring for 15 years. You helped a kid with a down payment. None of that felt irresponsible because it wasn't. It was just life. But it collided with sequence of returns risk, and that collision is what does the damage. I had a couple, both retired at 63, who came to me about 18 months after retiring. Their plan had been built around $78,000 a year in withdrawals. In year one, they spent $101,000. Year two, they spent $93,000. Their portfolio was down 19% because of market conditions at the time. So they were withdrawing more than planned from a portfolio that was already smaller than it should have been. In isolation, either of those things, overspending or a market drop, was manageable. Together in sequence, the damage was compounding. Practical takeaway. Build a separate transition budget for years 1 through 3. Assume it runs 15 to 25% higher than your steady state budget. Fund it from cash or short-term instruments, not your investment portfolio. Let the portfolio sit. Give it time to not be touched. But there's something underneath this spending pattern that almost nobody talks about. It's not financial, and it's number 3. Number 3, the emotional turbulence of early retirement is underestimated. I want to spend a minute here because this is the one that never makes it into the financial plan. And it should. Retirement is one of the largest identity transitions a person makes in their adult life. You've spent 30 or 40 years defining yourself partly by what you do. Your schedule, your colleagues, your sense of purpose, your status, a significant amount of that is tied to work. And then on a specific Monday morning, it's just gone. The research on this is substantial. A study published in the Journal of Economic Psychology found that emotional well-being in the first year of retirement often declines before it improves, specifically for people who had high professional identity and didn't replace it with structured activity. This matters for the financial plan in 2 direct ways. First, emotional discomfort drives spending. When people feel unmoored, they spend to fill it. Travel, renovation, purchases, not because they plan to, but because spending creates structure and novelty when the calendar is suddenly empty. That's where a lot of that 23% spending overage comes from. Second, emotional discomfort drives bad financial decisions. I've seen it more times than I can count. A person who spent 30 years making calm, rational decisions about their portfolio starts checking the balance every day. The market drops 8%. They call their advisor in a panic. They sell. They lock in losses. I had a client, executive, retired at 61, very accomplished, who described the first 6 months of retirement as the loneliest he'd felt since his 20s. He wasn't depressed. He just hadn't built the scaffolding. No new structure, no recurring commitments, a lot of empty days. In that period, he made 2 portfolio decisions that cost him roughly $60,000 in locked-in losses. Not because the market didn't recover, it did. Because he sold before it did and bought back in too late. Stay with me because this matters. Practical takeaway. Build your retirement life plan before you build your retirement financial plan. Volunteer work, part-time consulting, a board seat, a creative project, a physical routine, something that gives you identity and structure. It's not soft advice, it is direct financial risk mitigation, and that leads to the 4th thing that goes wrong, which is often triggered by that same emotional volatility. Number 4, panic selling in the first downturn is catastrophically expensive. Let me show you what the data actually shows on this. Dalbar has been tracking investor behavior against market returns for 30 years. Their most recent study found that the average equity investor underperformed the S&P 500 by 4.35 percentage points per year over the last 2 decades. 4.35 per year over 20 years. That is not a rounding error. That is the single largest drag on retirement outcomes. Larger than fees, larger than asset allocation decisions, larger than tax inefficiency. It is behavior, and the behavior concentrates in specific moments. Market drops, volatility spikes, scary headlines, the moments when the rational response is to do nothing and the emotional response is to do something. Here's the thing about the first 3 years of retirement specifically. You've never been a retiree before. You've watched market drops as an accumulator. They stung, but you didn't need the money. Now you do, or you think you do. And when you believe you need the money and the market is falling, the pull to sell is almost irresistible. I had a client, retired couple, 2008 retirees, bad timing, who had a $1.4 million portfolio. The market dropped 38% in 2008 to 2009. They panicked in early 2009 at what turned out to be very close to the bottom. They moved to cash. The market recovered 68% over the next 2 years. They missed most of it. By 2012, their peers who stayed invested were back to even or better. This couple was sitting on $810,000, not because of the crash, but because of when they left and when they came back. That's the difference between surviving the first 3 years and not. Did you or someone you know sell during a downturn and miss the recovery? Drop it in the comments. You don't have to name names. Practical takeaway. The antidote to panic selling is structural, not willpower. A 2-year cash buffer means you have 24 months of living expenses that are completely immune to market movements. When the portfolio drops 30%, you don't have to touch it. You already have the money you need. The decision was made in advance. But that buffer only works if it's actually built before retirement. And most people haven't built it. Here's why. And it's number 5. Number 5, the cash reserve problem nobody addresses before day one. Here's the thing most pre-retirees don't think about until it's too late. Building a cash buffer sounds simple. Hold 18 to 24 months of living expenses in cash or short-term instruments. Don't touch the investment portfolio when markets are down. Draw from the buffer instead. The problem is, where does that cash come from? If your retirement savings are 90% in tax-deferred accounts, which as Fidelity's data shows describes 43% of account holders, then pulling cash out to fund a buffer means triggering a taxable event. You're taking money out of a traditional IRA or 401k, paying ordinary income tax on every dollar, and parking it somewhere that earns less than inflation. A lot of people look at that tax bill and decide the buffer isn't worth it, so they don't build it, and then they're exposed. Here's what I tell clients. The buffer isn't a luxury. It is load-bearing financial infrastructure. It is the thing that keeps the investment portfolio intact during the most dangerous window of your retirement. I had a client, retired at 66, had done most things right, who came to me 6 months before his retirement date. He had $1.2 million in a traditional IRA and $42,000 in a savings account. That's it. No taxable account, no Roth. 2 buckets, pre-tax retirement and pocket change. We spent the 6 months before he retired doing partial IRA withdrawals, taking advantage of his lower income that transitional year to pull out $85,000 over 2 partial tax years, staying inside the 22% bracket, and building a cash reserve alongside a small taxable account. He paid tax on it, but he paid less tax than he would have later, and he entered retirement with a real buffer. He retired in early 2022. The market dropped 24% that year. He never touched the portfolio, not once. He was uncomfortable, but he didn't sell. That's the outcome a buffer is designed to produce. Practical takeaway. If you're within 5 years of retirement and your savings are primarily in tax-deferred accounts, start building your cash reserve now, deliberately with a tax strategy. Don't wait until the week before retirement and try to pull it all at once. The tax cost will be brutal and the timing will be wrong. But here's what most people miss, and this is where I want to spend the most time because it brings everything else together. Number 6, the withdrawal sequence is as important as the withdrawal rate. You've probably heard of the 4% rule. The idea, based on the original Trinity study, is that withdrawing 4% of your portfolio in year 1 and adjusting for inflation each year after has historically given a retirement portfolio a high probability of lasting 30 years. That's been updated since. Morningstar's 2023 research put the more current safe withdrawal rate at closer to 3.3% for a 30-year retirement given current market valuations and lower expected bond returns. But here's the part the rule doesn't tell you. Which account do you pull from first? Pull from the wrong account at the wrong time, and the tax cost alone can erode years of growth. Here's the general framework. And I want to be clear that individual situations vary, which is why I always recommend working with a CPA who specializes in retirement income. In most scenarios, the optimal withdrawal sequence looks like this. First, pull from taxable accounts, brokerage accounts, savings accounts. These are taxed at capital gains rates, which are lower than ordinary income. You're also eliminating those assets from future estate considerations. Second, pull from tax-deferred accounts, your traditional IRA or 401k. But here's the nuance. You want to draw these down strategically before RMDs force you to draw them down involuntarily at potentially higher income levels. Third, pull from Roth accounts last. Let them grow tax-free as long as possible. They're also not subject to RMDs, so they're the most flexible asset you have. The difference between a client who sequences withdrawals thoughtfully versus one who just pulls from whatever account is largest over a 20-year retirement can exceed $300,000 in after-tax income, same portfolio, same gross withdrawals, completely different net outcome. I had a client, couple, retired with $1.7 million split fairly evenly between traditional IRA, Roth, and a taxable brokerage account. Their financial advisor had been telling them to pull from the traditional IRA first because that's the money that's been growing tax-deferred the longest and should be used up. Well-intentioned advice. Backwards. By pulling the IRA first, they were accelerating income recognition, pushing themselves into higher brackets, increasing Medicare IRMAA surcharges, and shrinking the Roth accounts that should have been compounding the longest. We restructured the sequence. They started pulling from the taxable account first, doing modest Roth conversions in lower income years, and leaving the Roth to grow. The projected difference over 25 years, $340,000 in additional after-tax wealth. Practical takeaway, write down your withdrawal sequence, which account first, which account second, which account last. And review that sequence with a CPA, not just a financial advisor, because the tax implications drive the answer. That brings me to the final point, and the one that ties the entire first 3 years together. Number 7, there is no autopilot in early retirement. Here's the honest truth about the first 3 years of retirement. It is an active management phase, not passive, not set it and forget it. The decisions you make in that window, what you spend, when you convert, what you draw from, what you hold, have compounding consequences that run for 2 or 3 decades. Most people arrive at retirement thinking the hard work is over, you saved, you accumulated, you got to the number, now you just let it run. That mental model is dangerous, and the Fidelity data, which tracked 7 million accounts, backs this up. The accounts that sustained income the longest had one thing in common that isn't about asset allocation or return rates. They were actively managed against a written plan, not actively traded, actively managed. There's a difference. Active trading is reacting to markets. Active management is executing a pre-written strategy with discipline, adjusting the Roth conversion amount based on your bracket, replenishing the cash buffer when it gets low, rebalancing based on rules rather than emotions. And that plan needs to exist before retirement starts, not after the first problem surfaces. Here's what happens in practice when there's no written plan. I had a client, retired woman, 67, had done very well professionally, had $1.6 million saved, smart, organized, but no written retirement income plan. Her financial advisor managed her investments. Her accountant filed her taxes. Neither of them was looking at the whole picture. In year 1, she overspent, the classic transition spend. In year 2, the market was rough. She got anxious. In year 3, she had an unexpected healthcare expense of $47,000, a procedure not covered at the level she expected. She pulled from her IRA to cover it. That withdrawal pushed her into a higher bracket. Her Medicare IRMAA surcharge kicked in. She paid a premium penalty she wouldn't have paid if the withdrawal had been structured differently. None of those things were catastrophic in isolation. Together, in the first 3 years, they created a hole she spent the next 5 years trying to climb out of. She came to me in year 4. The first thing we did was build a written plan, withdrawal sequence, annual conversion targets, budget by category, cash buffer target, rules for what triggers a review. It existed. Finally, 3 years late. Practical takeaway. Before you retire, build a written retirement income plan. Not a financial plan, a retirement income plan that specifies your monthly income sources, your withdrawal sequence, your cash buffer level, your Roth conversion targets, and your spending guardrails. Review it every January, adjust it when life changes, but have it written before day 1. That's the framework. And now I want to give you the big picture version of why all 7 of these things concentrate in the first 3 years specifically. At the very beginning of this video, I told you that a 15% market decline in the first 2 years of retirement can permanently reduce sustainable income by up to 30%, even if the market fully recovers. Here's why that's true, and here's why the first 3 years are different from every other 3-year window in retirement. In the early years, the portfolio is at its peak size. You have more money exposed to the sequence than at any other point in retirement. A percentage drop on a large number creates a larger absolute loss. And because you're withdrawing, not adding, that loss cannot be averaged down. It's permanent. But here's the deeper truth. The Texas Tech research, the Vanguard spending data, the Dalbar behavior studies, they all point to the same root cause. It's not the market. It's the collision between human behavior and mathematical reality at the single most vulnerable moment of a 30-year financial journey. Markets dropped in 2000. They dropped in 2008. They dropped in 2022. Each time, the people who got hurt the most weren't the ones with the weakest portfolios. They were the ones with the weakest plans. The person with the written withdrawal sequence knew which account to leave alone. The person with the cash buffer didn't have to make decisions during the panic. The person with the transition budget didn't overspend the first year and compound the damage. 3 structures, that's all. The 3-layer retirement buffer. Layer 1, the transition budget. A separate, higher budget for years 1 through 3, funded from cash, not investments. Expect to spend 15 to 25% more than your steady state number. Layer 2, the behavioral buffer. 18 to 24 months of living expenses in cash or short-term instruments, built before retirement begins. Not for investment, for survival during volatility. Layer 3, the written sequence. A documented plan, which account first, which second, which last, and what your Roth conversion targets are each year before RMDs begin. Here's what I want you to do right now. Write down 3 questions, not later, right now. Do I have a separate transition budget for years 1 through 3? Do I have 18 to 24 months of living expenses in cash or near cash, separate from my portfolio? Do I have a written withdrawal sequence with Roth conversion targets? If you can't answer yes to all 3, you are entering the most dangerous window of your financial life without the structures that are specifically designed to protect it. That's not meant to alarm you. It's meant to give you enough runway to fix it. Because if you're watching this before you retire, you still have time. It happened in 1999. It happened in 2007. The same window, the same mechanics, the same behavioral breakdown. The people who survived those windows intact weren't luckier. They were prepared. If there's one sentence I want you to leave here with today, it's this. The size of your portfolio matters less than the structure around it. $1 million with no written plan, no buffer, and no withdrawal sequence is more fragile than $750,000 with all 3. I've seen it in practice over and over for 25 years. The first 3 years aren't dangerous because of the market. They're dangerous because they're when the plan gets tested for the first time, and most plans weren't actually built to survive a test. If you want to run the 3-layer retirement buffer check on your own situation, I put together a 1-page worksheet, what to calculate, what thresholds to look for, and what to do if you find a gap. The link is in the description. No email, no form, just a tool. And if you want to sit down and actually work through this with someone, map your transition budget, build your cash buffer plan, document your withdrawal sequence, that's something we do with clients. The first conversation is no charge. That link is also in the description. In the next video, I'm going to walk you through the Roth conversion window, the specific gap between retirement and age 73, when required minimum distributions begin, where you may have a narrow opportunity to permanently reduce your lifetime tax bill by 6 figures. I'll show you exactly how to calculate your window, which brackets to target, and what mistakes to avoid. That's next week. If you're not subscribed yet and you want content like this, no filler, no hype, just the mechanics of making retirement actually work, hit the subscribe button below. I'll see you in the next one.